Hello, everyone. I'm Tim Salem from PDX Real Estate Team, and today I have the privilege of bringing you an insightful conversation that will shed light on one of the most crucial steps in the home buying process, securing a mortgage. I'm joined by Julia Garriott with CMG Home Loans, a seasoned mortgage lender who has been instrumental in turning countless home buyers' dreams into reality. Julia comes with 17 years of experience and a track record of helping over 1,000 families in our community. We'll dive into the top questions on everyone's mind about home loans, from intricacies of interest rates to the ins and outs of down payments. So grab a notebook, get comfortable, and as we embark on this enlightening journey to demystify mortgages. Welcome, Julia. We're thrilled to have you here with us today.
Well, thank you so much for having me, Tim. I'm super excited to be here. So it's really an honor.
We appreciate it. So to start off with, there's a bunch of different loan types. Can you tell us about some of the loan types that are out there today?
Sure. So there are many different types of loans, Tim's, but the most common type is your conventional or FHA loan. Conventional, you hear about all the time. That's a 30-year fixed, 20-year fixed, 15-year fixed. And a conventional loan, typically you're going to need, anywhere between 3% down if you're a first-time home buyer to 20% down or more. Your FHA loan is for typically more of your first-time home buyers, and that requires a 3.5% down payment. We also do VA loans, which is for your veterans. That's 100% financing. And your USDA loans, which is less common, but that's 100% financing for homes in rural areas.
Perfect. So qualifying criteria. So what are the primary criteria that you look at when determining how someone qualifies for a loan?
Sure. So they do an application online with me. And the first thing that we do is pull their credit, right? So we look at their credit score. We also look at their income, and we look at their debts or their liabilities from the credit report. And those are kind of the three factors that we use to see if they qualify. So credit score, income, liabilities.
Okay. Because you brought up credit score, this is a question that comes up to me quite often is, I don't want to shop around. And people do shop around.
Right.
I don't want to shop around because each time I go to another lender, my credit score will be dinged.
That's a misconception.
Thank you.
So sure, of course. So if you're shopping for a mortgage, you should do it within the same 30-day period, because that one mortgage inquiry, if you do it within the same 30-day period, just counts as one inquiry. Now, I caution you, if you're shopping for a home loan and a car loan and a credit card, those are each separate inquiries, each separate dings against your credit score. But if you're shopping mortgage lenders and you want to look at 3 different lenders, just do it within that 30-day window.
That's good.
Yeah,
because everybody's always worried that it's dinging them 3 different times.
Yes.
So down payment, how much down payment is typically required for a home loan? And are there options for buyers with lower down payment?
Sure. And so with a conventional loan, if you're a first-time home buyer, you can do 3% down. With FHA, you can do 3.5% down. And if I can share real quickly, a really fun program that we have at CMG Home Loans is called Home Funded, which is a down payment platform that we offer not only first-time home buyers, but all buyers, where they can ask their sphere of influence to help contribute to their down payment. So that's a unique program that we have at CMG Home Loans. It's called Home Funded. So to give you a quick example, if you have a couple that's getting married and they have...
just going to say.
Yes, and they have a gift registry, instead of asking their wedding guests to buy them like pots or pans, they can ask their wedding guests to contribute to the down payment of their home. And they can come in with $50 even, and CMG will match up to $2,000. So it's a really, really neat program.
That's great. And for those of you who are getting married and thinking, oh, shoot, I wanted all those gifts, remember, you're going to have a housewarming party, so you can get those gifts then, too. Okay. So the next question is loan duration. Can you explain the differences in the loan durations, like 15-year, 30-year, and what advantages one has over the other? Some people.
Of course. So a 30-year fixed gives a buyer more flexibility in their mortgage payment, meaning that your mortgage payment is going to be typically less because it's spread out over 30 years. However, on a 15-year fixed, typically your interest rate is, even though it's less, your payment is higher because the duration of the time is less. A lot of people like to do the 15-year fixed if they can, because over the span of the loan, they will pay less interest. But for the most part, I look at recommending the 30-year because you could always pay more if you wanted to.
Yeah. Right. At the end of every year. In fact, I tell most of my clients at the end of every year, add another at least $500 to the escrow account. That way your mortgage payment that you see regularly now will be the same. That added to escrow will cover the tax increase, because that's things that will change. Your mortgage interest rate will never change if you're on a fixed rate, but those taxes and the insurance goes up every year. So add a couple extra things.
And another quick hint too for that, some people talk about biweekly payments, but what you can do is you can take your total, principal and interest payment, forget about the taxes and insurance, divide that by 12, and just at the end of the year, add that amount to the payment, and that kind of equals paying an extra payment per year.
So let's just read it out.
Yeah.
Tell us a little bit about the pre-approval process. Why is getting pre-approved so important, and what's included in the process?
Sure. So a lot of people ask the difference between pre-qualification and pre-approval. And pre-qualification is just somebody saying, hey, Julia, we're thinking about buying a house. We kind of want to know how much we could qualify for. And I don't pull their credit. I don't necessarily look at their pay stubs or their tax returns. I just say, I write out the numbers and I say, well, potentially you could qualify for this. Pre-approval is really the way to go if you're even ever considering purchasing a home, because then I actually pull your credit report. I get whatever type of employment you have. If you're a W-2 income earner, I get your pay stubs and your W-2s. If you're self-employed, I get your tax returns. But it gives me the full picture. And then I find out, what you're hoping to put for a down payment, what you're hoping for a monthly payment. And then you actually have something concrete to work with. And if, again, as I mentioned before, if you're not ready, then at least we have a plan, a path to get you to move forward towards home ownership. And you can't go out and look at homes with you, Tim, without that pre-approval letter, really. I mean, if they find a house they love.
They can. They're going to fall in love with something they can't afford.
Yeah.
I always say you should get pre-approved first so you know what you're looking for.
Right.
Closing costs. Closing costs. So what costs should buyers be prepared for at closing?
Of course. So the closing cost, I can just ballpark and say you're going to look at closing costs anywhere between, let's say, $4,000 and $5,000. That's a general ballpark. That includes an appraisal, third-party fees, etc. And I won't go into the prepaids, which are the property taxes and insurance, because that can vary. There are ways to roll it into the loan. For example, if you had a $400,000 loan or purchase price, and your total closing cost and prepaids were $10,000, you could essentially offer a seller $410,000 and then say, "Can you pay $10,000 of my closing cost and prepaids?" So the seller is still getting the $400,000. Your $10,000 is rolled into the loan amount, and that's getting covered. Of course, the seller has to agree to do that. So
that's fantastic. Yeah, and then it still has to appraise, which that's minor difference. I usually don't see that's big of a worry.
Right.
So refinancing. When does it make sense for somebody to consider refinancing?
Well, most of the people that could refinance have refinanced in the past few years when the interest rates were down in the threes. But it makes sense now to refinance. Well, first of all, on October 1st, the student loan payments started coming back. And also the other thing is that we've seen a lot of people get into more and more credit card debt. And when the Fed keeps raising those short-term rates, that affects your credit card interest rates. So interest rates are going higher on those variable types of debts. And so we're seeing that some people are having to do a refinance, not because they're getting a lower rate, but because they're having to pull cash out and pay off some of those debts. And a lot of people have equity now, as you know. Equity values continue to grow. So people are able to pull that equity out and pay off some of that debt. Or they could refinance to buy another property if they really wanted to.
Got it. And there's one thing that I've noticed in your programs with your company, at least, is if you're buying at today's higher interest rates, you have a program where if you refinance within 5 years, it's...
Yes. So that is called, yes, it is called Rate Rebound. It's a Rockstar Rate Rebound product because basically, and you could purchase now, and as Tim mentioned, you can refinance anytime within the next 5 years, multiple times. The interest rate does have to drop by 0.5%, but we cover basically all the costs, appraisal, etc. Plus, I think the unique part of it is we give $1,000 towards third-party fees. You'll hear of maybe some other lenders saying, "Oh, you could refinance for free," but I don't think any of them have it in writing that they will pay for all this plus give that extra $1,000.
third-party fees for anybody out there is going to be, you're going to have to pay for title insurance again, potentially, for that new loan. And that's one of the third-party fees that may be in there, plus any other title fees that come.
Exactly, yeah.
How does a buyer's credit score impact their loan terms and interest rates?
Yes, so typically, again, on a conventional type of loan, the lower the credit score, the higher the interest rate. And so if we see a lower credit score, we'll usually push that borrower or look at putting that borrower in an FHA loan, since an FHA loan doesn't rely so much on the credit score for the interest rate.
Loan programs, are there special loan programs available for first-time home buyers?
Down payment assistance programs come and go, and you have to fit inside of a certain box in order to qualify. There's income limits, there's all kinds of different limits. And so I always recommend when people are asking me about these down payment assistance programs to go through the pre-approval process, because we have to see where they stand with credit, income, et cetera, to see if they will fit in certain boxes and where they're going to live, because different counties may have different types of down payment assistance programs.
So when you're talking to a new buyer, I'm sure you're interviewing them on many things, because some of the most documents or some of the most personal documents that you're going to be sharing during this whole process, it's not going to be with the realtor, it's going to be with the lender. So the lender is more than likely going to be interviewing you, asking you a couple questions about what you do for a living, where you work. And they're going to, as a mortgage broker, almost always think of a program that may fit any special situation that you may have, because there's other programs out there.
Thanks for bringing that up. We do have a first responder program too, like you mentioned, that helps. It has assistance for the closing costs and that type of thing. So it's true. It just kind of depends on your situation, income, credit, what type of work you do, et cetera.
Debt to income ratio. Can you explain the importance of a borrower's debt to income ratio and what limits lenders typically look for?
Sure, of course. So for a conventional type of loan, well, debt to income ratio, first of all, is we look at your gross income before any taxes are taken out. And then we look at your liabilities from your credit report. So if you have any car payments or credit card payments. And then we add that to the new monthly mortgage payment, so including the estimated property taxes and insurance. So we add those liabilities from the credit report, the new monthly mortgage payment, add those two together, and we divide that into the gross income. And that's your debt ratio. And you want to stay typically on a conventional loan below 50%. FHA will allow you to go up to 56, depending, okay? But you're getting a little high up there, and that can make it a little risky. Even you don't want to be house poor. So
definitely not.
Yeah.
So the other thing that we're always hearing out there is mortgage points.
Yes.
So what are mortgage points, and how can they affect a borrower?
Sure. So you can pay points to buy the interest rate down. So sometimes people will say, well, I want an interest rate of 6%. How much will that cost me today? And I can just look at a rate sheet and say, here's what this interest rate costs today, or here is what the interest rate is with no points at all. What you have to look at is, if I'm going to pay $5,000 to have a slightly lower rate, what is the difference in monthly payments between the rate with no points and the rate paying $5,000? Is it going to make sense to pay points for a $30 or $40 monthly payment difference? And often what we're seeing now is I wouldn't advise someone to pay a lot of points, because experts are saying that interest rates are going to come back down. And if you pay that money up front and then you refinance in a short period of time, you've just lost that money.
You kind of have to do the math. And people, I tell my clients, before you do anything like that, let's figure it out together. I'm a math geek. So let's figure it out together. When is that payback point going to be? Because if it's 3 or 4 years down the road, it doesn't necessarily make sense to pay those points. So just to clarify too, a point, what is a point?
So, well,
a interest, a point is like a interest.
Well,
1%. 1 point is 1% interest.
Right, but it doesn't necessarily correlate. So I can't just say, if you pay 1 point, that's going to move your rate from 7% to 6%.
1 point is 1%.
Yes. Yes.
That's not changing the interest rate. But
yes.
People don't know, okay, why are you typing points instead of interest? A percentage of my loan. So a point is equal to a 1%. 1 point is equal to 1%. So I want to clarify that for people out there asking, what's a point? What's a percent?
Got it.
So future communications. So once someone has a mortgage with your company, what kind of ongoing communications or support can they expect?
Oh my gosh, I stay in touch with my clients until they tell me to go away. No, I like to be the mortgage gal for life, truly. In fact, I just have somebody set up in a system after they close that I reach out to them, 30 days after they close to make sure that they're doing okay, 3 months, 6 months, a year, do an annual mortgage checkup. Even if they're in a perfect loan, I still want to see how things are going. And so I just stay in constant contact because that's really important to me to make sure that they're taken care of.
That's great. And I'm sure that you probably bring to them any new programs or something else that may help them out.
Oh, of course.
Right.
Of course.
So, Julia, it's been a pleasure talking to you today. I appreciate you here answering questions for people out there who may have them and wondering what the home buying process is like and what the lending process is all about. So again, I appreciate you being here with us today.
Thank you so much, Tim. It was a pleasure.